Hi, it's David Bromley. I want to talk today about steps 2 and 3 of best trading practice and how they relate to money management. And in particular, in this video, I'm going to be talking about step 2, which is staying in the game. Money management is the strategy or the element of your trading strategy that deals with two things. It manages your risk and it allows your compound growth to deliver its fortune by maximising your reward. As far as managing your risk is concerned, or staying in the game is concerned, risk presents itself to a trader in two ways. Either through the possibility of a catastrophic event and the trader blowing up because he's too heavily exposed to the market. So something like the 9/11 terrorist attack or the 2007 global financial crisis, and you're too exposed. Or probably more commonly, by way of sort of attrition, where you're taking position sizes that are too large and you go into the inevitable run of losing trades, which all trading systems have to suffer from time to time, and you go into what's known as a drawdown, where your capital is diminishing from a high point. And at this point, you're likely to, if you're going to be questioning your system, it's at this point. And traders who've taken large positions tend to become demoralised, and they tend to lose confidence in their overall strategy and quit, even if they've got a trading system that they've tested and appears to have merit and appears to have an edge. So it's really vital that you get this kind of position sizing aspect of your trading strategy correct. Now, I mentioned in an earlier video the money management strategy called the fixed fractional money management strategy, because it's the only one, but because it's one that I think has merit, and it's one that I think is very popular with system traders. And what this seeks to do is it seeks to equalise the risk that's presented by each of your individual trades. Now, the reason you do this as a system trader is because system traders don't predict the outcome of individual trades. In fact, we tend to say, look, at that level, at the individual trade level, we have really no idea what the next trade will bring. It's a bit like in this year's Wimbledon tournament, we may feel that we could predict the last 8, the quarter-finalists, say in the men's tournament, with a degree of confidence. But as far as who's going to win the tournament, it gets to the point where it becomes sort of almost random. And it's the same with trading systems, where you feel that as a group of trades, you can have a look, you can test your trading system and get to the point where you believe it has this edge. But as far as the individual trades are concerned, they are pretty much random, and no individual trade really presents a better opportunity than another. So why should it carry more risk? And what the fixed fractional money management method does is it seeks to apply a fixed percentage of your capital to each of your trades as far as risk is concerned. So you need to be able to establish what risk each of your trades presents, and there's a way to do this. And then you position your trades, you buy as many shares or contracts in each trade as is appropriate for that level of risk. So as your capital increases, your position sizes increase in absolute terms, but your level of risk for each of those individual trades stays the same. And what you can do, and what you will do, is when you test your trading system, is you will test as part of your complete trading system not only the way it gets in and out of the market and the other aspects, but what level of risk you would apply to each of your trades. And you'll see how remarkable the effect on your results will be when you gradually change the level of risk. And you'll get a feel for what is an appropriate level of risk for this particular kind of trading system. And this is what traders use this mechanism for, and it's absolutely vital to your results that you do this. So even the traders who have a trading system with an edge, I've said before, the majority of them find a way to fail because in this particular case, perhaps they haven't looked carefully and systematically at the way that they size their positions. So this is the first job of the money management strategy to manage the risk, which is absolutely vital. And the second job, which is to maximise your reward, is done simultaneously and automatically by the same formula. And in the next video, I'll take a look in a bit more detail about how that's done and the importance of doing that. So just like the casino, who have a mathematical advantage over the gambler, it's still necessary for them to control the bet sizes. And if it's necessary for them with their mathematical certainty, it's certainly necessary for us as system traders. So we've got to do this, and that's really covered kind of at a high level the money management formula from that perspective. So thanks again for your time on this video. If you have any comments, please feel free to ask questions or leave a comment, or even give me a like or something if you did like it. And I'll speak to you again soon. Thanks again.